Bitcoin investors woke up to news of a shocking digital heist.
Breaking overnight, nearly 100,000 bitcoins have been stolen from exchange platform Bitfinex
by a relatively unknown American artist.
Sold for nearly $70
million.
That's more than most Picassos, Monets, or Warhols.
And it doesn't exist in physical form. It is only available digitally.
It's the first NFT ever sold at auction.
Non-fungible token, NFT.
NFTs, or non-fungible tokens.
Explain NFTs to people that don't know what you're talking about.
Most people who buy crypto lose money. Not a little money. Most of it. But you would never know that from your social media feed because the people who lost everything stopped posting. The ones who got rich kept going. And your brain does the rest. It sees the winners. It remembers the winners. It starts to believe the winners are the norm. They are not. That gap between what you see online and what actually happens to the average investor, that is exactly what this video is about. And by the end, you are going to have a very different answer to the question everyone keeps asking. Studies show varying loss rates among crypto investors, ranging from 38% who sold for less than they paid, LendingTree, to over 70% of new Bitcoin investors who lost money according to Bank of International Settlements research, nearly half. That number never makes it into the highlight reel. Think about the last time you saw someone post about losing their emergency fund on Solana. You did not, because that is not how social media works. The winners keep posting, the losers go silent, and your brain fills in the rest. The platform rewards the winners with attention. The losers disappear. And your perception of what is normal gets rebuilt around the exception, not the rule. Every time you see a screenshot of someone turning $5,000 into $80,000, there are thousands of people who turned $5,000 into $800 and never mentioned it again. The platform rewards the winners with attention. The losers disappear. And all you ever see is the highlight reel.
Away a hard drive which contained 8,000 Bitcoin. That crypto wallet is now worth $950 million.
And if you've invested in Bitcoin, well, yesterday was probably not the day for you. The value of Bitcoin plummeted. At one point, it was selling for under $61,000, and that's now half of its all-time high of more than $126,000, which was reached back in October of last year. Now, this drop comes as tech shares also fell.
Here is what the math actually looks like. You put $10,000 into crypto, it jumps 50%, and you are sitting at $15,000. Then it drops 50% from that peak. Most people assume they are back to where they started. They are not. They are sitting at $7,500. That is how volatility destroys wealth even when the average return looks fine on paper. The gains and losses are not symmetrical. A 50% drop requires a 100% gain just to break even. Most investors never stop to think about that. It gets worse the bigger the swings get. A 75% gain followed by a 75% loss does not leave you where you started. It leaves you down 56%. You need a 225% gain just to recover. This is the math that nobody puts in the marketing material. Bitcoin drops 3 to 4 times harder than the S&P 500 during downturns. From October 2025 to February 2026, Bitcoin fell from $126,000 to below $60,000. That is a 50% collapse in 4 months. The S&P 500 returned roughly 17.8% in 2025. No emergency, no collapse, no sleepless nights. Now here is the part that almost nobody talks about. Buy Bitcoin in December 2017 at $19,000 and you spent 3 years underwater. Buy it in January 2018 and same story. Buy it at the peak in October 2025 and you lost half your money before spring arrived. Same strategy, same conviction, completely different outcomes based on nothing but the date you happen to buy. That is not investing, that is timing. And timing is not a skill most people have. It is luck dressed up as strategy. Buy the S&P 500 at any point in the last decade and hold for 4 years. You made money every single time. That is not a coincidence. That is the difference between an asset that builds wealth and one that transfers it. And the losses are not just hitting beginners. Bitcoin whales have locked in over $30 billion in losses this year alone. The people with the most information, the most capital, and the most experience are still getting crushed. So why do so many people keep buying? That answer is a lot more uncomfortable than the math. Comment one word right now. Are you in crypto, out of crypto, or somewhere in between? One word, that is all. Because what you are about to find out next is the reason most people cannot answer that question honestly, even to themselves. The honest answer is that crypto is not really an investment for most people. It is a casino that learned how to do marketing. And before you push back on that, consider what an investment actually does. A share of stock represents ownership in a real business. That business has employees, revenue, products, and customers. When the business grows, your ownership grows with it. There is something underneath the price. A bond pays you interest. There is a contract. There is a mechanism. Crypto has a price, and the price goes up when more people decide the price should go up. That is not fundamentally different from how a Beanie Baby worked in 1998. Now some people will say the blockchain technology has real utility. And that is true, but utility and price are two different things. The internet had real utility in 1999. That did not stop the Nasdaq from collapsing 78% between 2000 and 2002. The technology survived. Most of the investors did not. The same pattern has played out in crypto multiple times. 2017 to 2018, Bitcoin collapses 84%. 2021 to 2022, Bitcoin collapses 77%. The entire crypto market loses over $2 trillion in value. Entire projects that had billions in market cap disappeared completely overnight. FTX had a Super Bowl commercial. Celsius was paying 18% yield and calling it safe. Both are gone. And the people who trusted them are still trying to recover. These were not fringe projects. These were platforms that were being recommended by influencers, celebrities, and financial media as legitimate vehicles for building wealth. They are gone. And the people who trusted them are still trying to recover. Nobody talks about what happens after the gain. Take $50,000 in crypto that doubles to $100,000 in 8 months. That feels like a win. Then you sell. First the fees hit. That advertised 0.1% trading fee suddenly becomes 2% or more after spreads, execution delays, and withdrawal charges. You lose $1,500 before you even see a tax form. Then the real number arrives. Hold crypto for less than a year and your profits are taxed as ordinary income. At the 37% federal bracket, your $50,000 gain costs you $18,500. So walk through what actually happened. You started with $50,000. You ended with $100,000. You paid $1,500 in fees and $18,500 in taxes. You are taking home $80,000. You doubled your money and kept 60% of it. And that is the best case scenario. That assumes you timed your entry and exit perfectly. That assumes no gas fees, which on Ethereum can run $20 to $50 per transaction and spike higher when the network gets congested. That assumes no mistakes, no panic selling, no second guessing at the wrong moment. Most people do not get the best case. There is another tax trap that almost nobody warns beginners about. Every single crypto trade is a taxable event. Not just when you cash out to dollars. Every time you swap one coin for another. Every time you use crypto to buy something. Every time you move between tokens. So if you traded Bitcoin for Ethereum 6 times over the course of a year while the market was moving, you potentially owe taxes on 6 separate transactions, even if your overall portfolio went down. People have received IRS notices for owing taxes on crypto gains in years where they ultimately lost money, because the trades that were profitable were taxable even if the overall year was a disaster. Now compare that to holding an S&P 500 index fund for over a year. Long-term capital gains rates max out at 20%. The same $50,000 gain costs you $10,000 in taxes instead of $18,500. The fund charges 0.03% annually. No gas fees, no spreads, no surprises, and you are not triggering a taxable event every time the fund rebalances because that happens internally. The difference between those two outcomes is not skill, it is structure. Crypto is built in a way that requires you to be significantly right just to break even. The fees, the taxes, the volatility, they all stack against you before the market even moves. And the people who actually did get rich from crypto? Most of them did not do what you think they did. The biggest crypto fortunes were not made by people who bought Bitcoin in 2020 and sold in 2021. They were made by people who got in before 2013. People who were mining when Bitcoin was worth less than $1. Founders and early developers who received tokens before there was a market for them. The people you see on social media who turned $10,000 into $1 million represent a window that has almost certainly closed. Because for every person who bought Bitcoin at $100, there are now millions of people buying it above $50,000. The math that made early adopters rich does not work anymore. The market is too large, too saturated, and too efficient for those returns to repeat for the average person entering today. What you are seeing on social media is not an opportunity. It is a memory being sold as a roadmap. So can crypto actually make you rich? Yes, it has, for some people, under specific circumstances that are increasingly difficult to replicate. But the person watching this video right now is almost certainly not that person. Not because you are not smart enough, not because you do not work hard enough, but because the window that created those stories has mostly closed, and what remains is a market that benefits the early, the connected, and the institutional players far more than it benefits the individual investor trying to build a future. The average crypto investor is not buying at the bottom and selling at the top. They are buying when everyone is excited, selling when they panic, paying short-term tax rates on whatever gains they manage to keep, and watching fees casually eat the rest. The math does not lie. A $50,000 investment that doubles still only puts $80,000 in your pocket after fees and taxes. Meanwhile, the person who put that same $50,000 into a boring S&P 500 index fund 10 years ago turned it into roughly $230,000 without losing a night of sleep. No gas fees, no IRS surprises, no checking the price at 2 a.m., no watching an influencer tell you to buy something that disappears 3 months later. Here is the real question, not whether crypto can make someone rich. It can. It has. It probably will again for someone somewhere. The real question is whether it is the most reliable path to building actual lasting wealth for someone who is not already wealthy, not already connected, and not already watching the charts every hour of every day. Because if you are investing to change your financial future, the boring option has a better track record than the thrilling one. It always has. The people who got wealthy over the last 30 years were not the ones chasing the exciting thing. They were the ones who bought boring funds, held them through crashes, ignored the noise, and let time do the work. That strategy has never gone to zero. That strategy has never had a founder arrested for fraud. That strategy has never required you to understand gas fees or wallet addresses or what a blockchain actually does. It just works. And if that sounds too simple to be worth your time, that feeling right there is exactly how the casino gets you through the door. If something in this video hit different than you expected, that is the point. Subscribe. Because every video on this channel is built to show you the number behind the assumption. And the next one is going to make you rethink something you thought you already had figured out. The next one might change how you think about something you assumed was already settled.